What are ETFs? Extraterrestrial frogs, enormously thick forests, exchange-traded funds. That last one is what we're going to discuss in today's video. This is day 3 of 100 Days of Finance, where the whole goal is to give you more personal finance education in 100 days than 99% of people receive in their entire lifetime. My name is Derek, and I got my degree in finance, so you don't have to. Let's get right into the video. So, what are ETFs? ETFs, also known as exchange-traded funds, are investment funds that are traded on an exchange just like stocks. They are designed to track the performance of a particular index or basket of assets such as stocks, bonds, or commodities. They are similar to mutual funds, but unlike mutual funds that have active management, buying and selling assets, and making decisions, which costs money, ETFs are passively managed or basically automatic. They only seek to track an index or a basket of assets, which means that there are virtually no fees, except a small one known as an expense ratio. And the good news, even though mutual funds are actively managed, most rarely outperform ETFs. Now, the purpose of an ETF is to provide the investor with a diversified portfolio that can be easily bought and sold. They work by pooling money from multiple investors to buy a portfolio of assets, which are designed to track and mimic the performance of the index or asset class that they are tracking. For example, there is an ETF that tracks the S&P 500. There's also one that tracks the tech sector, etc. And that reminds me, tomorrow I will be uploading a video that breaks down the top 5 ETFs for the everyday investor. It's going to be a good one. Anyways, once an ETF is created, it basically adds up the total value of all the assets in the ETF's portfolio and divides it by the amount of shareholders. That becomes the price of the ETF, which can then be bought and sold just like a stock. Again, one of the main advantages of an ETF is how low the costs actually are. Unlike mutual funds, ETFs are passively managed. That means there is no team of managers and analysts making buy and sell decisions, which means there's no one to pay. ETFs are also highly liquid, which makes them easy to buy and sell at any time. This provides you, the investor, with the ability to buy or sell as needed to structure your portfolio the right way, based on your age and risk tolerance. And yes, of course, I am making a video on structuring a portfolio the right way in this series. Anyways, there are many types of ETFs, and they each have their own unique value proposition. For example, there are also bond ETFs and commodity ETFs. And as we know, bonds make up a portion of a well-diversified portfolio. So you can instead use a bond ETF to structure that instead of trying to buy bonds individually. So one of the main benefits of an ETF is its ability to help you diversify your portfolio. And since ETFs track a particular index or asset class, they provide you, the investor, with exposure to a wide range of assets, which reduces your portfolio's overall risk. Remember the great saying, diversify to stay wealthy. Look, ETFs are great, and for most people, they should make up the bulk of one's portfolio. But even if you are going to use ETFs in your investing, you still need to make sure you are picking the right ones. Which is why in tomorrow's video, we are going to be discussing the top 5 ETFs for the everyday investor, as we continue our journey of 100 days in finance. So make sure to subscribe and hit the bell notification so you don't miss the 100 days worth of financial education. I hope this video was fun, easy to watch, and enlightening. Again, my name is Derek, and I got my degree in finance, so you don't have to. I love this stuff. It's been my passion for over a decade, and I love being able to share that with you. So I can't wait to see you on tomorrow's video.